Hey guys, it is Patrick, and before you dive into this lesson, I wanted you to know that you're about to start a new section of Principles of Accounting, and you can actually head to my website at www.patrickleemsa.com, where you can actually purchase and then download and then print the worksheets that go along with this lesson and all of the lessons that are connected to this section of Principles of Accounting. It's a great way to take notes so that you can actually concentrate on what I'm teaching you in our lessons, and then you can able to write notes along with the notes that I am showing on your screen. So all you have to do is head to my website at www.patrickleemsa.com. There you can purchase them and then download them, and then you can use them on this and all of the lessons that are connected to this section. So go ahead and do that, and if you are ready, let's head into our first lesson in this section right now. All right, welcome to section 4, where we're going to talk about adjustments. Now, what are adjustments? Adjustments is a process that accountants do at the end of the period to make sure that their books are accurately showing revenues and accurately showing expenses at the end of the day. Now, in this section, we're going to show you the journal entries that one would make in order to adjust the books so that they're properly reporting the revenues as well as properly reporting the expenses on the income statement. Now, why are they important? They're important because we use accrual accounting. Because we use accrual accounting, cash may come before or after a revenue or an expense, and because of that, we might not have our books as accurate as possible because we haven't seen the actual cash transaction. So an adjustment needs to be made in order to either show the revenue or not show the revenue, or show the expense or not show the expense because it has or has not been incurred yet. And so that's what we're going to be doing in this section. Now, at the end of the section, we're also going to be looking at closing entries. With closing entries, we're going to show you how we get the books ready for the next year. So let's get started here with this lesson. This lesson is all about an introduction to adjustments. Now, adjustments is a process in the accounting cycle that requires a company to bring their books up to date based on transactions that they did throughout the accounting period. So our goal is to make sure that our books at the end of the day are up to date. That's what we're trying to do with adjusting entries. Now, an adjustment or adjusting entries are an end of the period adjustment. That's when we do them, or end of the period activity. That's when we actually do them. So this is not something that you would see an accountant do every day per se, but when we get to the end of the month or at the end of the year, this is what accountants are doing to make sure that the books are up to date. So the adjustment period happens at the end of a period, not on a daily basis. Now, when we talk about adjustments here in this section, one thing you should know is that cash is never part of the adjusting entry. So if you see cash in the entry, that's not an adjusting entry. An adjusting entry, which you'll learn in a minute, or throughout this section, is going to involve everything other than cash. Okay, so if you see cash, it's not an adjusting entry. Now, cash can be part of the entry before the adjustment or after the adjustment if we're talking a timeline standpoint, but cash itself is not done on the adjustment date. Okay, so remember that as we start looking at journal entries. Now, here's an example of what an adjustment is and what you need to know as you go through the adjustment process. So right here you see a chart, and let's assume that we're looking at an account. Let's say we are seeing, this would be deferred revenue. So we look at deferred revenues, and deferred revenues has a balance of $4,000. Now, if you remember what deferred revenue is when a customer pays us cash up front, and then we perform the service later on. So we haven't earned the revenue yet until so we can't book the cash that we received as revenue. We book it as deferred revenue. So we have $4,000 of deferred revenue that we haven't earned yet as revenue. And when do we earn it? We earn it when we provide a service or we provide the good that we were going to promise to the customer. So we look at our deferred revenue and it's $4,000, and through a couple of analysis and looking at performance obligations through the revenue process, we notice that that account should be $2,000. So what has happened? Well, 2,000 of the 4,000 we've actually earned through the revenue process through the end of the year. And so what the adjustment process does is we need to look at how much the account is now, how much should it be now, and the difference. So in this case, our $2,000 difference represents the adjustment that we need to make in the adjustment period. So we have to figure out, how do we get the deferred revenues from 4,000 to 2,000? Well, we take it out of deferred revenues and we now book it as revenues because we've now earned it through the performing the performance obligation that we said we were going to do. So that's what we're doing as an adjustment, is we are trying to book the difference between what the account is now and what it should be. That difference is going to be our adjustment. So why are adjustments needed? Well, these are reasons why adjustments are needed. Revenues are recorded in the proper period in which it was earned. So we want to make sure that revenues we might have done in 20x1, but we get paid for it in 20x2. We want to make sure that we report those revenues in the period that we earned them, which would be 20x1. So we may not get paid for it until 20x2, but we still need to report it in the year that it was earned. Same thing goes for expenses. Expenses are recorded in the proper period in which it was incurred, not necessarily paid. So if we've incurred any expenses during the year, we need to book those even though we haven't received a bill, we haven't paid on those expenses, we weren't notified of those expenses. If it was incurred during the year, that's when we need to book them, in the year that they were incurred. Assets represents how much economic benefits it has at a point in time. So we need to make sure that all of our assets represent what we actually have or what we actually are expected to receive in any given period. So if we earned revenue, then technically we would expect payment in the future. We might not get the payment today, but we expect it in the future. Therefore, we need to make sure our assets properly reflect how much is owed to us at the end of the period based on all the services that we perform so far. Same thing goes with liabilities. We want to make sure that the liabilities actually represents how much is owed at a point in time. So for instance, if we have utility expense, the utility company will bill us in the next year for this year's electricity. We still should put the electricity expense that we incurred at the last part of the year, as well as how much is owed to the utility company. If we don't put how much is owed to the utility company, then our balance sheet is off because it doesn't reflect actually how much we owe to other people. We're missing that utility expense. So those are 4 reasons why adjustments are needed. Now, the key to understanding adjustments is to understand what is going on, what the number is now, what the number should be, and what do you need to do to get the number from where it is now to where it should be. So as you go through adjustments, the hardest part of adjustments is not knowing what's going on. And so you kind of have to step back and go, okay, what is the account now? What does the account need to be now? And what's that difference? And then how do we make that adjusting entry? So I press upon you as you go through the examples is to take one step back and go, okay, what's the account now? What has happened that warrants a change? And then if that change is going to happen, what is that balance going to be in the trial balance, I guess you could say. And then what's the difference between what it is and what it isn't? And then that change or that difference is what we're going to have to book as an adjustment in this section. Okay, so we can categorize all of the adjustments into 2 types. We've got something called accruals, and we also have something called deferrals. So we have accrual adjustments and deferral adjustments. Now, we can break that even more on the accrual side. We have something called accrued expenses And we also have something called accrued revenue. So we'll talk more about those later, but accrued expenses mean that you've incurred expenses now, but you haven't paid them yet. Accrued revenue means you've earned the revenues now, but you haven't received the cash yet from your customers. On the deferral side, we've got two as well. We have deferred expenses as well as deferred revenue. Now, what are deferred expenses and revenues? Again, we're going to talk about that in another lessons, but on a deferred expense side, we're saying that we paid cash for the expense now, but the expense hasn't been incurred yet. We are going to defer the recognition of the expense until later when we've actually incurred the expense. On the deferred revenue side, the deferred revenue means that we received cash up front, but we really haven't done anything for that cash. So we need to defer the revenue until we actually provide the service or provide the goods according to the contract and according to the performance obligations that we have to meet to the customer. So that's what we're going to be working on over the next 10 lessons, 10, 12 lessons here, is we're going to show you how to book accrued expenses, how do we book accrued revenues, how we book deferred expenses, as well as how do we book deferred revenues. And what you should know is some of these entries you've already done. You did them in section 3 when we talked about income and expense transactions and different types of transactions and journal entries that you can incur. So that's an intro to adjustments. I can tell you that adjusting entries are a little bit difficult. And the reason why that they are difficult is because there isn't this source document that you receive to say, hey, you need to book the adjustment. We kind of have to think about what has happened in the past that warrants an adjustment. And for a lot of students, that's the hardest part. But as we go through these examples, I'll break them down and show you how we tackle an adjustment and then kind of the structure of what the journal entry would look like. So I'm not going to give you maybe the exact journal entry because each transaction or each journal entry is going to be a little different, but I'm going to give you that blueprint. And once you know the blueprint, then it's kind of just plugging and playing with those transactions and those journal entries at the end of the day. So I hope you enjoyed this introduction to adjustments, and we'll see you in the next lesson. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? It would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.